Welcome back. In this video, I'm going to discuss how you build a two-stage DCF model. So I'll start off talking about the process for building this model, and we'll talk about the necessary components for DCF models, and then we'll walk through a two-stage DCF model. Okay, so how do we perform a two-stage DCF? Well, there's really four main steps to this. Step one, we're going to estimate sales revenue and then all of the other line items necessary to calculate our free cash flows. Step two, we're actually just going to calculate our cash flows individually. So there's a couple of different types of cash flows that we could calculate. The two that we're going to use in this video are going to be the free cash flow to the firm and the free cash flow to equity. We'll talk about each of those in turn. Step three, calculate your discount rate. So we've talked about the cost of equity, so the required return right there. You can also use the weighted average cost of capital if you're using the free cash flows to the firm. We'll see this in practice. And then finally, we're going to discount our free cash flows by our discount rate. And that's the final way that we get our intrinsic value. We just discount all these cash flows back to the present and QED. Okay, so step one. In order to calculate our free cash flows, we need to have a good sense of how much revenue, how much net income, how much in the way of depreciation our firm is going to have in the next couple of years. So we need to forecast out a lot of these line items on the income statement and the balance sheet. And there's two primary ways that we could do this. The easier one is going to be the second one, but there is something out there that I like to call the line item forecasting approach, where we forecast out every single line item on our pro forma financial statements, aka our forecasted financial statements. So we individually determine, for some reason we think net income is going to be 7% of sales revenue this year, even though the last 5 years it's been 3%. We basically individually estimate each forecasted line item going forward a couple of years. This method, horribly time consuming. The easier approach is the percent of sales method. And with this one, our primary focus is on estimating future sales, or rather future sales growth. And then we just assume that every other line item, like net income, gross income, huge number of things, tax liability, all of these things remain the same ratio of total sales in the future that they were in the past. So all we're doing is just trying to forecast sales growth. If you can estimate that, this is the easier method. Okay, so how do we actually estimate future sales in the percent of sales method? Well, we could take the naive approach and assume that sales are going to continue to grow the way they have in the past. So if sales growth has been 5% forever, we just assume that future sales growth is also going to be 5% forever. The better method is going to be the second one, though. Adjust the future sales growth based on the information that you collect. I mean, this is why we do fundamental analysis, to try and more accurately estimate sales growth in the future. I mean, number two is the way that if you're an analyst, you would want to do this. All right, so once we've forecasted out all of our line items, step two, estimate our cash flows. So our cash flows, these are going to be based on those line items we just forecasted. And all we're doing is just taking those line items and plugging in the necessary information to get our free cash flows to the firm or equity. I'll show you the models for those free cash flows here in a second. So next step, calculate the discount rate. Discount rate, we have two different ways that we do this. Discount rate is just the rate at which we discount our free cash flows over the entire future. If we're using, let's say, the free cash flow to equity, or FCFE, then we're going to use our required return, similar to what we did with the Gordon growth model. So basically just use the CAPM to estimate your cost of equity, aka market cap rate or required return. If we're using the free cash flow to the firm method, though, we want to use the weighted average cost of capital as our discount rate, because this one, the free cash flows to the firm, these are the free cash flows that are being generated for every stakeholder in the firm, not just the shareholders, but also the bondholders and preferred shareholders. And then finally, once we've estimated our free cash flows, say 1 year out, 2 years out, 3 years out, we just discount them back to the present using our discount rate, either the weighted average cost of capital or the cost of equity, and this will give us the intrinsic share price. Okay, so where does this two-stage DCF model come from? Well, the two-stage DCF model comes in when we realize that we can't perfectly forecast out every single free cash flow for the next 1,000 years. Eventually, our estimates of free cash flow are going to get really inaccurate. So what we typically do is break up our free cash flows in the future into 2 time periods, the forecasting stage and the terminal value stage. And the forecasting stage, this is where we try to estimate our percent of sales for the next 3 to 5 years. So maybe our sales grow by, 5% next year, 10% the following year, -1% the third year, et cetera, et cetera. But at some point, we're going to get really inaccurate at estimating our sales growth. And at that point, that's where we use a second stage. That's where we just start assuming that our sales and then ultimately our free cash flows grow at a constant growth rate, aka a dividend or free cash flow growth rate. So this is primarily where I like to use the Gordon growth model. I don't like using the Gordon growth model by itself, but using it in the second stage, aka the terminal value stage of the two-stage DCF model, is definitely a better way to use it. So what I'm trying to get at here is our two-stage DCF model has 2 stages, the forecasting stage and the terminal value stage. Forecasting stage, we're individually estimating our free cash flows. Terminal value stage, we're assuming that those free cash flows at the end of the period, say year 5, continue to grow at a constant growth rate. And then we just calculate the value of our free cash flows from year 5 to year infinity, discount those back to year 5, and then ultimately discount that value back to the present. Okay, so we have 2 types of discounted cash flows calculations. We have the free cash flows to the firm, and we have the free cash flows to equity. And let's talk about how we use the free cash flows to the firm in this 2-stage DCF model. Well, the free cash flows to the firm, the way we typically are going to calculate that is using this model right here. So we take our earnings before interest and taxes times 1 minus our tax rate. So basically, this is just ultimately it's earnings before interest because we've subtracted out taxes. We add in depreciation because depreciation is a non-cash expense, and so it's already been taken out, and we need to add that back in because no cash changed hands. We'll subtract out any expenditure we made for capital. So if we bought a car or a new building or something like that, that takes cash out of our hands. And then ultimately we'll subtract out the change in net working capital. So if we are purchasing supplies to make inventory, that takes cash out of our hands, and that's going to decrease our free cash flows to the firm. So we just plug these in to get our free cash flows to the firm. We go through the entire 2-stage DCF process using these free cash flows, discount them using the WACC, subtract out the debt, add the cash, and divide by number of shares outstanding, and we're done. Just for reference here, our WACC, or weighted average cost of capital, hopefully you saw this in Finance 300. Hopefully you remember this from Finance 300. This is just the weighted average of our costs of capital. So if we have debt and equity that our firm has issued, we just take the weight of debt times the cost of debt, so generally the yield to maturity, times 1 minus the corporate tax rate because debt expenses are tax deductible, and then we just take our weight of equity times cost of equity. So ultimately, this thing represents the average cost to raise the next dollar of capital for this firm. Now, the free cash flows to equity method, it's a little different. I mean, nothing else really changes that much. We just have a slightly different way to calculate our FCFEs. So we just take net income plus depreciation times change in net working capital times change in net PPE or capital expenditure, and then we add in any borrowing. Because if we borrow, we're getting $1,000 from our bondholders, and we can use that to actually, we can return that to the shareholders. There are a lot of other equations out there for free cash flows to the firm and FCFE. Another one I have is right here. So FCFE is equal to FCFF minus interest expense times 1 minus our corporate tax rate plus the increase in debt. Ultimately, we just plug in these FCFEs, and we can just use these the same way we were using with the FCFFs. It's just FCFEs become the things that we discount to the present, and then ultimately we discount them at the cost of equity rate and divide by number of shares outstanding, and that'll get us our intrinsic value. Okay, so let's go ahead and take a look at a real-world example. I've got about 5 or 6 of these in our spreadsheet for this week. So if we want to take a look at, valuation of Delta or a valuation of Blackstone or a valuation of, I think Southwest is also in there, feel free. But I'll show you Macy's. So Macy's, it became the company I like to beat up on when I first started at Ball State, and I just kind of saved one of those valuations. So let's take a look at this thing. So here we go. This is a pretty traditional 2-stage DCF model. The way we typically read this, we have our inputs up here at the top. So these blue cells, these are just assumptions that I made. So tax rate, I just tried to forecast or estimate this based on their past tax rate. Net working capital growth, PPE growth, these were pretty consistent through time, so I just kept them the same. Sales growth, I actually took this using some analyst forecasts, and then change in total debt. I took a lot of this stuff from what I could find out there on the internet. Weighted average cost of capital, I just plugged in a pretty, didn't know exactly what the weighted average cost of capital was when I was first building this model like 7 years ago, but just plug in 5% for the time. Growth rate, for a lot of mature firms, you typically want to set this at 2% to proxy for the long-term economic growth rate. But when I was building this model, notice here that for the actual historical financial statements, you can see that the total revenue is declining through time. It's declining by about 50 basis points a year. So I decided to just plug in a growth rate of 50 basis points, so negative 5%, or negative 0.5%. Next, once we get these inputs and we put together our income statement data and our balance sheet data, we can calculate our free cash flows, and that's what's happening down here. But let me go ahead and go up here to our forecasting period. So this is the period, the 5 years where we're forecasting out into the future. So these, I've not gone back and checked since I created this thing back in like early 2019. But you can kind of get a sense of like what I expected the sales growth, total sales revenue to be. Obviously with COVID, I was a little off. I think, a couple of these numbers are pretty below this, especially these 2 years. I also forecasted things like, operating expenses. So, all I'm doing here is just setting my sales growth rate expectations, setting my expectations for margin expenses, calculating things like EBIT, subtracting out the interest expense, and then ultimately doing things like just calculating every other useful line item on here. And as I get down here further, for some of these assumptions, I'm assuming some pretty broad generalizations like PPE. I'm assuming it's growing at a pretty constant rate, or I think there's actually a negative growth rate. Net working capital, kind of the same thing. This firm is shrinking, so I just wanted to proxy for that shrinking. And then debt, I just assumed debt would grow or shrink at a constant rate based on how it had shrunk in the past. And then down here, we have our free cash flows. And here's my calculation or forecast of Macy's free cash flows. We have the firm's net income minus taxes. So that's the blue. 0 is depreciation. I think oh, that's right. The Macy's did something where they combined the PPE here, so it's net PPE instead of gross PPE. So this is basically just our FCFF formula here, and then we just have the change in PPE and the change in net working capital. And so ultimately, here's my stream of free cash flows. And then I have a terminal value cash flow right here. So just assume that this last cash flow in 5 years is going to grow at a constant rate, say negative 0.5%, and we're going to discount that at a 5% WACC. And so here we have a stream of free cash flows to the firm. And we also, I went ahead and calculated the free cash flows to equity here using one of the models I had in the PowerPoint slides. So ultimately, I just do the same thing. We have our free cash flows to the firm in this column, and our free cash flows to the firm, or free cash flows to equity in this column. Ultimately, I know the number of shares outstanding. Those are right here. And I can calculate the net enterprise value just using the NPV formula and the weighted average cost of capital. Subtract out the debt, add the cash. Ultimately, this is the intrinsic market value of equity, and I divide by number of shares outstanding. And ultimately, my intrinsic share price for Macy's using the FCFF calculation and two-stage DCF is about $40. With the FCFE model, I've used the same techniques here, just discount all these cash flows to the present at some discount rate, and then shares outstanding, and then divide our intrinsic value by shares outstanding, and I'm getting about $23, $24. So this is typically how we use a two-stage DCF model. We try to put a lot of the inputs up top so that they're right here. I've linked our intrinsic price per shares right here. So let me go ahead and actually get rid of some of this fill. And this is what we're after, these two things. These things tell us the intrinsic value of Macy's shares with these inputs. If I were to set this growth rate at 2%, notice here that the share price jumps up tremendously. Obviously, that's not been the case with Macy's. I think I was pretty accurate in forecasting a negative growth rate. So there we go. If you're wondering what Macy's is trading at right now, here it is. 5 years after I performed this valuation, Macy's share price is about $20.10. So if we look at the 5-year performance, you can kind of get a sense of, hey, I was pretty accurate. It's kind of eerie how accurate I was. I mean, the high here is about $34, and tends to be right around 20, 21, 23, something like that. So all good. Okay, a couple final points on these free cash flows models. So I just used a two-stage DCF, but you can also use a three-stage DCF. And generally the way we do this is we just assume that we have a forecasting period, and then a high growth period, and then a long-term growth period. So say like a period where you're growing at like 6%, and then maybe it trails down to like 2%. You can also kind of incorporate analyst forecasts for sales growth into these valuations. If you're an analyst yourself, you would never want to rely on someone else's forecast. You'd always want to do this yourself, though. Okay, a couple other things. Changes in CapEx, depreciation, net working capital, these things are not consistent. I mean, this is part of the big challenge with these two-stage DCF models. They require a lot of judgment. It's why we don't really, I'm not going to ask you to build one of these yourself and think about every single component until you get to portfolio management. You'll do that in extreme detail in portfolio management. EBIT, sometimes you'll see this called the operating income on the income statement, means one and the same thing. And then average tax rate, generally this is a pretty good proxy for your forecasted tax rate. And then long-term growth rate, I always recommend go ahead and use the expected GDP growth rate of about 2%. Or if you're in a high growth sector like tech, you might even consider using the industry growth rate. So I think the highest long-term growth rate I've ever considered using would be for one of the big tech firms like NVIDIA. I would probably assign that at about 6%, something like that. And then there's a lot of other things you can do. You could use scenario analysis. You could use sensitivity analysis. You could use Monte Carlo simulation. You get all kinds of cool things that you can do once you've built this model. This two-stage DCF model is kind of like the best model out there for mature firm valuation. Okay, so comparing the valuation models. Quite frankly, whoever builds this model, you're going to get different valuations. Some people are going to use certain characteristics, other people are going to use other characteristics. And in any model, especially these DCF models, you are going to have to make simplifying assumptions. How do I forecast the growth in PPE? Well, I could assume that it grows the same rate it has the last 5 years, but maybe last year this firm had a really big jump in PPE. So what do I use? Well, it's your judgment. You have to be able to justify what assumption you've made because you are the analyst. There are a lot of problems with these DCF models, so these calculations can be pretty sensitive to some inputs like the growth rate or the discount rate, and it's really hard to estimate growth opportunities. So I'd say valuing a company like Ford is going to be much easier than valuing a company like TSMC or NVIDIA or some very, very small tech stock. There are a couple of other final best practices in valuation I do want to leave you. Number one, in the two-stage DCF, I always like to use GDP growth or the GDP growth target as our long-term growth rate. So in the US, that'd be like 2.5%. I always recommend using multiple models just because this is going to give you a range of valuations. It's a bad analyst that just uses one model and then says, this is my valuation. You want to take a look at what every valuation model that is relevant gives you and then assign a valuation. And then finally, depending on the firm, certain valuations should be considered more heavily. So for high growth firms, if you remember we talked about market multiples, I would use market multiples for high growth firms. DCF, especially like a single stage DCF or maybe a two-stage DCF, might not be appropriate just because how do you factor in the high growth that this firm might have for like 10 years? Okay, so let's summarize. With these two-stage DCF models, always use free cash flows instead of dividends. So we have the FCFFs and the FCFEs. In practice, you want to use a two-stage DCF model as opposed to the Gordon growth model, which is a single-stage model. And then ultimately, the most important considerations in two-stage DCF are going to be the ones that are most sensitive, or your model, your intrinsic value is most sensitive to. And those are going to be your growth rate, your long-term growth rate, G, and your discount rate, R. So we'll see this in practice in class, but these are things that are very, very important in these valuations. So with that, I'm going to conclude, and if you have any questions, just feel free to ask. Thank you.